All right, cool. Today we're talking about contingencies, a special kind of contingency. And this is a contingency for people that are either a buyer, for buyer and seller. I should make this buyer and seller. I'll leave it at that. I just occurred to me. I need to have my medicine adjusted. I know that. I know. So what are we talking about? I started a beautiful PowerPoint slide. So there's a listing. This is starting on the right. And a buyer wants to buy the listing. But the buyer has a house that the buyer needs to sell in order to buy the listing. So the buyer wants to make an offer to purchase the property contingent upon their selling the property they already have. So let's assume that the seller said, okay, now the buyer needs to sell the property they already have, but they don't want to sell the property they already have unless they know they can buy the property they want to buy. So they put a contingency in the sale of their property that it's contingent upon them closing on the replacement property, and the replacement property has a contingency that they have to sell their original property. Right now, let's start with strategery. So I go on a listing appointment. Nice little house near Apple. They're moving to Santa Rosa. The seller says, is it okay for us, because we haven't found the house in Santa Rosa yet, but we want to sell our house and we would like to make that contingent on us being able to buy a house in Santa Rosa. Can we do that? And my answer was absolutely, no problem. We can do that. We got a form, right? We can make the sale of your property contingent upon your buying a property. They said, okay, great. That's what we wanted to hear. So they list the property with me. Now, that's not what we did, because rather than debating them at that moment, I took the listing. Now, when it came, then what I would say to them, what you need to be doing now is you need to find properties in Santa Rosa. You need to feel confident that you can find properties in Santa Rosa that you're willing to move to. Because I pointed out to them that if when a buyer makes an offer, and we had a buyer we listed it for 999,888, and we had an offer for 1,110,000. Not too bad. And I explained to them that if they mess with that 1.11 offer by sticking in a contingency that says we're not going to sell to you unless we find another property in Santa Rosa and buy it, chances are we're not going to get as much money. First of all, there's a good chance that the buyer is not even going to want to buy the property because they're not looking for a property that maybe they're going to be able to move into possibly sometime in the future, but we don't really know. That's not what the buyer's looking for. They're looking for a solid property that they can buy. So if we have we won't sell to you without buying a replacement property contingency, we're going to get a lot less from the sale of your property. But let's say we can't, I mean, convince them to do that, to accept that contingency. Now you're going to you're in a hurry to buy the property in Santa Rosa because you've got a limited amount of time to find the replacement property, which means you're probably going to pay more. Now, if you make that property, the one you're buying in Santa Rosa, contingent upon the one you're selling in Santa Clara, you're going to have to offer more money in order to buy that other property. You understand, if in the world of contingency, I have to sell a property or buy another property, this is the worst contingency. right? This is the most open-ended, most who knows what's going to happen kind of contingency. So if you're a seller, when would you accept an offer contingent upon the buyer selling their property? Well, maybe if they offered you a whole lot more money than anyone else, right? So you understand the dynamics here. They're going to get less on the one they currently own if they're the buyer. They're going to pay more on the one that they're purchasing. And when you add those two together, $100,000, given the prices in Silicon Valley, $100,000 is what that could cost. I told them, you could stay in a hotel, a nice hotel, right? Have breakfast in bed every day for the amount of money it's going to cost you to do it like this. Now, there are some shimmies we could do, like extending possession. So what we actually did in this case is we told the buyer of our listing that they needed a little bit of time, a couple of weeks. And they had already found a property in Santa Rosa. And we sold the one in Santa Clara, not contingent. We bought the one in Santa Rosa, not contingent, but by the time we had written the offer in Santa Rosa, we had already removed all the contingencies on the one in Santa Clara. We had an escrow closing date coming up, and we used the estimated net sheet from the listing in Santa Clara as proof of funds for the purchase of the one in Santa Rosa. And because none of them were contingent, everything closed on time. They got 2 weeks to get their money, pay for the mover, move all their stuff, and move into the other property. So one way of doing this, which just involves contracts and not Jodie yet, but just involves contracts, if we can delay possession on the first leg, and then, we could have some time to get the money, find the other property, and move. Is there risk? The answer is yes. Now, all of contingencies involve allocating risk. If you have all the contingencies, the sale based on the replacement property, the purchase based upon the sale of the other property, you have no risk, but it's going to cost you, right? Whoever takes the risk usually saves money. Does everybody understand what the issue is here? Any question? All right.
Yes, I have a question. So you had no contingency either on the sale or the purchase. Got very fortunate. Usually that doesn't work out as smoothly as you said.
We were already in escrow,
right,
on the listing. This was within a few miles of Apple's campus.
Okay.
Listed for under 1 million because I knew it'd create a frenzy, which it did.
Right.
Right. We weren't worried about selling it. They were looking in Santa Rosa. Once we had all the inspections, so the offer was non-contingent. The buyer had plenty of money. Now we're feeling a little confident. Is it possible? What would have been the worst that would happen?
They didn't find a house.
They could have lost the deposit on Santa Rosa.
Right.
But they would have got the deposit in Santa Clara.
Correct. And they probably would have to rent something or be in a hotel until they found something.
No, because worst case scenario, they could stay at the Ritz, given the difference that this would make in price. Right. I'm just saying, right? Now, yes, there was some risk in that.
Very, very interesting. Thank you for sharing, because usually brokers will have, contingent on sale of another property.
Right. Well, I'm just saying it costs you money to do that. Now, Elena has a question.
Yes, thank you, Michael. So I did come in a few minutes late, so I'm sorry if you already said this, but my clients right now, as you know, they don't want to sell their house before they find their next property because they have blah, blah. But they don't have the funds for a down payment liquid. They're using a home equity loan, and it's a VA So Jody doesn't like it. I don't like it. I don't know what to like or not like, but
Well, we sometimes can't control them. Jody's here listening. Just
oh, hi Jody.
Hi there.
So how can I convince them um to be open to the strategy of putting their house on the market now?
well, first of all, the question is, how serious are you about buying a property wherever they're buying? It all comes down to motivation. In my case, the clients were serious about going to Santa Rosa. They were going, this wasn't, oh, maybe we will, maybe we won't. So now the question simply was, how many properties are there in Santa Rosa in your price range that you would be willing to buy? And if the answer is several, well, now we have a little bit more comfort. Now, in your case, it kind of sounded like there was only one property they wanted to buy. And if they couldn't buy that one property, then they don't want to do anything. Now, that has to do with the buyer's level of motivation. They're not that motivated.
Okay.
Right. If they were we really want to move up into a bigger property, or we want to move down, or we want to move out, and we're really serious about that, then this works better.
Okay.
Now, right now, one of my team members who is not on the call, I don't think I would, but he can tell me if he is. We have one of these going on. And by the way, this is part of the conversation you'd have with your client. We have one going on where the agent on my team is a listing agent, and the buyer has made an offer which has been accepted contingent upon the sale of their property. All right. And the question is, why would this seller take that offer? And the answer is because their listing has been on the market for 9 months. So if somebody says, this is the only way I want to do it, I don't want to have any risk, can I do it? The answer is yes. We just have to start looking at properties that have been on the market more than 100, 200 days. Now, that's usually not the one they want. Now, if they're willing to buy a property that's been on the market for 9 months, this is going to work. Well, I'm going to go through the form. This will work because they have no other option.
Okay.
Right. But if we're talking about a property that is on the market for 10 days and the open houses are like anthills, and the listing agent is saying, I'm getting calls all the time, and you're expecting multiple offers, and you go in with a contingent upon the sale of property offer, you just need to know you're not buying that house. This is what I tell them. Can we do it? Yes, we can do it, as long as you understand you are not buying that house.
Okay.
Because they're going to have multiple offers, and this is the worst contingency.
So if the house has been on the market for 6 months, do you think it would work?
Sure. It depends on how desperate they are.
Okay.
If you haven't been on a date for 6 to 9 months, you lower your standards, right? Because originally those sellers had high hopes for the kind of offer, but after 6 months, they would be willing to think about anything.
Okay.
Right.
Yeah, thank you.
Right. But where this becomes a real problem is when they want to buy a property that's fresh, recently on the market, looks good, popular. It will not work. This is not going to work.
Okay.
Right. It's just not going to work. So, but let's go through the form, because this has come up a lot lately, which is why I've decided to do this. Now, I'm going to ignore that. All right. So we're going to start with the contingency for the sale of buyer's property. This all begins, in fact, both forms begin on the residential purchase agreement. The second one could be on a counteroffer. But in the grid of the residential purchase agreement, line L9 is the sale of buyer's property. And notice it says it's not contingent unless the box is checked. And if you check the box, it loads the form. Now, you would start by, date of the purchase agreement, address, and that sort of stuff. Now, here's the first onion in this process. So the buyer and the buyer's agent who's filling out this form has to answer the question, what is this contingent on? Now notice the default session is buyer entering into a contract for the sale and closing escrow on buyer's property. B is only entering into the contract for the sale of buyer's property. That's a little more risky. C is only the close of escrow buyer's property. So let's say the buyer's property, there are 3 levels of this. Level number 1 is the buyer hasn't even listed their property. That's the worst. Level 2 is the buyer has listed the property, but it hasn't been purchased yet. That's a little better, but still not so good. The next level is the buyer has listed the property, somebody's made an offer, but there are still, how about this? Contingencies have been removed. Now at that point, my question would be, why are you making it contingent? Right? If you're already in escrow and you've got a closing date, then why make it contingent? Right? Because if all the contingencies on your sale have been removed, why are you making your purchase contingent on that closing? Well, something could go wrong. Okay, how much are you willing to lose in bargaining power for that assurance? You see what I'm saying? So if it's about to close, that's not as bad. If it hasn't been listing, that's bad. Right? That's bad. So you would pick, which of those apply. Notice it says this is the time frames the buyer has as a default 17 days to sell their property. Now, if it's already listed, the question is, how long has it been on the market? And one of the things you'd be doing if you're the listing agent and you got one of these offers is you would want to run a CMA on the property that they're selling. Because you understand the worry for the seller is they haven't even listed it. What if when they do list it, they are greedy and they want a price that is not going to happen, which means it's never going to sell, which means the contingency is never going to be removed, which means all the seller has done is taken the property off the market for a while, and they're going to have to start over again. Aisha has a question.
Yes. Is this a situation where you would consult with the listing agent if they have their home listed already, or no?
The buyer usually has an agent who's usually
Right.
the listing agent. But you would want to see you'll see they're going to give you an address and you're going to look it up and see whether or not it's on the market. They have to answer the question: is it already on the market? Have you already listed it?
Okay, thank you.
So the default is 17 days. You could write in a shorter one, but again, you would need to know where the buyer's property is. What are the average days on market in that area? What are they? How long does it normally take to sell a house? Do you understand that if the buyer is under pressure, like let's say the average days on market is 25 or 30 days, and they have only 17 days under this contract to sell their property, do you understand they may not get as much because they're under pressure? They have to sell the property quickly, or this whole thing is going to fall apart. Hence, they're probably not going to get as much money. By the earlier of the time in 2A, that's 17 days, or within 2 days after buyer entering into a contract for the sale of buyer's property, buyer shall deliver escrow evidence to the seller. You have to prove that you're in contract. Listing of the buyer's current property. First choice, buyer has signed a listing agreement for buyer's property. If the answer is no, they haven't done that, and you pick shall within 3 days, this is not good. Because we don't even know what they're going to list it for. We don't know if it's a reasonable amount. We don't know how long it's going to take to sell. We don't know what kind of condition. We don't know anything other than, oh, well, we'll put it on the market, trust us. But they check the box that say they are going to do it within 3 days. Too many of these I see the box checked. One of them said 5 days. They're going to actually sign the listing agreement. And then you write in the name of the listing broker. So that's the worst. 3B, buyer's property is or will be submitted in the MLS in the area the buyer's property is located. Buyer's property will not be submitted in the MLS. If they check that box, they're not even going to put it in the MLS. They better have an off-market buyer. And buyer shall give the seller evidence of the listing agreement, the MLS listing, within 1 day of acceptance of buyer's property if it's already listed. So part of what, if you're the seller and you accept this and it's already listed, they have to prove that it's listed. If it's in the MLS, they have to give you a copy of that. Any questions so far?
I have a question.
Yeah.
How often does this happen? Because like, who would go out looking to buy a house, planning to sell their house, but they haven't put it on the
I
market?
think we have 3 or 4 going on right now.
Wow. Okay.
Yeah. I mean, and what, like in Elena's example, they found a house they liked, but they hadn't sold the house they had. And Jody might remember, I'm trying to think of the name of the clients. They had a house in Almaden, remember that? And then they wanted to buy a house in Los Gatos. And it was
we went non-contingent. Meanwhile, we needed to sell it. And by the powers of the universe, I don't even know how this happened. Best case scenario, they got an all cash offer, closed in 10 days. Their money was in their account before our new purchase closed, and it was beautiful, but that was crazy. And I don't think that's a normal thing. Definitely not your baseline, but
I wouldn't count on it. Yeah.
Right. Never count on that. But we took a big risk there, but it paid off.
Right. Both of us were surprised that it worked that well.
I have about 1,500 new gray hairs still from that transaction, but yes, it worked.
Right. So what happens is, and this is sort of what's happening with Elena's client, they're kind of sort of interested. They see a house, they love it. Now, in this other case that Jody and I had, the other house was like 5 million or something. And the one they owned was like 2 million. There's a lot of money riding on this. But they saw a house they loved and they said, we want this house. And then they're giving us like 2 days to find the way they could buy it. All right. Now, what Jody's going to talk about, and maybe we could, I don't know how long because we could just talk about that now. I don't know if you have anything you want to show, or do you want to just explain it, or do you want me to finish this? Then you can do that.
Yeah, I've got just a little one slide that just gives some info, but I'm happy to talk at whatever point you'd like.
All right, let me finish the form, and then between this one and the other one, we'll talk.
Okay.
But you understand, so sometimes that's what happens. They fall in love with the house. Now they want to sell the house, but they've done actually nothing to get their house ready for sale. It's not listed. It's not on the MLS. And we're rushing to throw this together, and sometimes it works. The combined value of these two is like 9 million. Sometimes it works, but sometimes not so much either. So how long does the contingency last? This is the sale of buyer's property contingency. Notice it says that they had 17 days to enter into a contract. Okay, well, how long do they have to close? Oh, well, that kind of depends. So if they don't sell the property within 17 days, then the contingency isn't being met, and you can give the buyer a notice to perform and kick them to the side. Let me jump to the real onion, right? Which is really in paragraph 7. and I've highlighted 7C because this is the real issue. In the old days, this whole section was called the release clause. And in the MLS, when you would put in a property, you could say contingent with release. And what contingent with release meant is that there was a release clause. Notice those words aren't used anymore, but that's what this could be. So what 7A and 7B say is that 7A says that the seller has the right to continue to offer the property for sale and to take backup offer. Now, they would have to have it in the MLS as contingent with a release. By the way, if you're having trouble finding a buyer a property, you want to look for these because it's possible that they could get out of that transaction if they got a better offer. Now, what this paragraph says is that if the seller gets a better offer, they can give a 2-day notice to the buyer, and if they can't remove the contingency and prove they have the money without selling their property, which of course they can't, that's why they're doing it. But I guess they could finance it, which Jodie's going to talk about, but usually they can't. So what that would mean is that if the seller gets a better offer, a non-contingent offer, and they want to go with it, they can give the buyer a 2-day notice. And if the buyer can't remove the contingency and prove they have the money, it's over, they're thrown out, that's it. Now, as you can imagine, this is not what buyers want because, and this is where 7C comes in. 7C, and I focused here, 7C default says that the seller has the right to accept another offer and give a 48-hour notice to the buyer immediately, anytime after acceptance. Buyers don't want that because they're like, well, I'm putting my home on the market, which I don't really want to do, but I'm only doing it so I can buy this property. And now you're telling me if the seller gets a better offer that doesn't have my contingency, they can kick me to the curb. And now my property's already in escrow. Now my property's already been listed. I don't want to do it. So C2 says, if you check the box, that during that 17-day period that the buyer has to enter a contract on the sale of their property, the seller can't kick them to the curb. They can't give them that 48-hour notice. And that's better than the default, but still not something the buyer typically wants. In the one we have going on right now, where the property was on the market for 9 months, they picked 7C3, which basically says the seller can't exercise that contingency ever during the term of this agreement. Can't, right? So that's not good. Now, you understand there's still a contingency that the buyer has to sell their property in 17 days. And if they don't, you can give them a notice to perform and cancel, right? You can do that. So does everybody understand? Let me just, and then I'm going to have Jodie explain a financing alternative, right? There's also the other onion that's connected to this is a lot of times when buyers want to buy contingent upon the sale of the property, they want the sale of the property contingent upon their buying the property, just so they don't have any risk at all. And that would require the SPRP, the seller's purchase of replacement property. This could be in the residential purchase agreement, but it is oftentimes in a seller counteroffer. So the seller gets an offer. That's what my clients wanted to do in Santa Clara. The seller gets an offer. Buyer says, I want to buy the property. The seller wanted to, let's counter it with putting in this form. But I talked them out of it. So this isn't one of the addendums you can just check in the RPA, but you would go to other where it says addendums and write in seller's purchase of replacement property. If you represent the seller, you would counter the buyer's offer and add this as an addendum, the seller's purchase of replacement property. So you're going to see there's some similarity between the two in that it says the seller, that this sale is contingent upon seller entering into a contract to acquire replacement property. Usually they've already done that, but it gives them 17 days. Then notice B, this is better. Seller has entered into a contract to acquire replacement property already, right? Which in Elena's case would be they make an offer, the offer is contingent upon the sale of the property, that offer is accepted. Now they're selling their property and they want to make it contingent upon the closing of that one, that would be B. And if you're already in escrow and it's just a couple of weeks to close, then you could check C. But again, I understand it's safer, but if you're that close, why make it contingent? You know, because you understand this would discourage a buyer. Because if I'm buying a property without even knowing whether or not I'm going to get it because it's contingent upon them buying another property and I don't have any control over that, and what if that doesn't happen? Who knows? Now, sometimes this all works out. We represented the seller. The buyer wanted to buy contingent upon the sale of their property. They entered into a contract, and that contract was contingent on their buyer selling their property. I actually had to draw this out for our transaction coordinator because it was just confusing because all of these forms were being used, and it eventually did close. So I've given you an explanation about the time periods and all of that. Are there any questions? And if I don't know if there's any questions about this, I'm not necessarily going to go through the form because I've covered the parts that would be checkable. You know, it says if the seller's replacement property falls out of escrow or is canceled, the seller must notify the buyer within 2 days. This keeps the buyer updated on any issues. The contingency has to be removed in writing. The buyer can cancel. So if you've got a contract with the buyer contingent upon your buying a replacement property, the buyer could cancel that contract if the buyer has found a better option. And a NSP is a notice for seller to perform. Any questions about this? My bottom line is we would like to avoid doing this if at all possible, right? That's my my take on this, because it's going to cost the client money if they have all of these contingencies. So what is the option? Jody, can you think of any options?
I can think of a couple of options. Yes.
You could share your screen if you felt.
Okay. Perfect. Let's see. Okay, let me know if you can see that.
We can see it.
Perfect. Okay. So just to start out with, I want to go over these options, and then I want to say a couple things about the market, because I'm sure everyone heard the Fed drop, half a point. And I want to tell you what that means for mortgage rates going forward. So, but let's stay on topic for now. So there are a handful of options that we can look at for your clients to see if this would work for them if they have to go non-contingent. Oh, I'm sorry, forgive me, if they have to go contingent. As Michael said, it is not the best option. The way I kind of described this to Elena yesterday when we were talking about her situation is, think about a gas line being run, and maybe you've got an obstacle that you've got to get past to get that gas line from start to, where you actually want it to be. And you've got this one pipe, but you've got to throw some elbow joints in, right, to kind of go around the obstacle. Each time you do that, that elbow joint is a potential failure point, right, where you could have a gas leak that you don't, unless you smell it, you're not going to know it's there. So anytime we have transactions like this, where there's all these different potential points of failure, of course, it increases stress for everybody involved. There are some simple answers and solutions, but of course, a lot of times the clients don't want that. They want us to work the miracles and the magic. So we've got to try to do that, at the same time acknowledging that these points of failures are not your fault or my fault, of course, but they're there. So how do we get around them, if at all possible? So I've got these options here. One is a bridge loan. You'll hear some lenders call it a bridge loan. In my world, I call it a home equity loan. There are lenders that do home equity line of credit, which I think, especially for Elena, and we'll talk about this on our call tonight with your client, is probably better, because a home equity loan, you're pulling out, all the money right now, every bit of it, say $300,000 if that's what you need, and you're going to start paying interest on it right away. A home equity line of credit is open-ended, so it's a line, so the borrower or the client can open up a home equity on departing residents and just let it sit there and use it if they need it for the transaction. The problem that you may run into is equity lines, whether they're closed-ended like mine, a home equity loan, versus an open-ended, a home equity line of credit. You're going to have a hard time finding lenders that will do that investment property, because that's what that departing residence is going to look like to a lender. If that borrower calls in and says, hey, I want to buy another house, so this is what I'm going to do with this line, it makes lenders really nervous to do that on investment property because of the risk. So, but it is there. For me to do a purchase, if the borrower wants or needs the bridge loan, I wouldn't actually be able to do the bridge loan at the same time of the purchase. So they would have to go elsewhere for that. And Elena, we'll talk about that with yours later. But it is an option. So they used to be very popular way back in the day before the meltdown of, 08, 9, 10, all of that. But they're making a comeback. There is a need for that kind of financing out there. But you're going to have to find a lender that will do it investment property. Borrower could go to a lender and not tell them what they're doing, but that's not really what we encourage, right? Because we don't want to keep things, we want to keep them on the up and up. So just, make sure that they're fully disclosing what their purpose is when they take these loans out. But it is there. One of the downsides is that payment does count against their debt to income ratio, right? Because whether it's a line of credit or a loan, there's no requirement that this loan is paid off. It's not a short-term loan where, okay, you've got to pay it off in 60 to 90 days. This is going to be pretty much your fully amortized 20-year on a line of credit, 30-year on a loan. So that payment does have to be counted on the line of credit. To note, even if they don't have any money pulled out on that line, so that line is, say $300,000 line with a zero balance, the lender will count 1% of that line against them as a payment, because they could take that out, right? So they would be looking then at a $3,000 hit to their debt to income ratio if they have to do this. FHA is an option. So let's say on the new purchase, the previous purchase is conforming, and the new purchase, they can't sell their house and their ratio is over a 50, then what are the options? Not that they can't, but they haven't yet. What are their options? They can look at FHA on the new purchase. FHA will go up to a 57% debt to income ratio. Not every lender will go up to 57%. Rocket will. We have no overlays. What that means is a lender will take the guidelines, whether it's FHA, Fannie, Freddie, and they will say, okay, FHA, I understand you'll go to a 57%, but we're not going to originate loans over 53 for FHA, or we're not going to go over 50 for FHA. That's called an overlay, and lenders can do that. Rocket doesn't have that overlay. The only overlay we have for FHA is that we're not going to go below a 580 credit score, but that's still pretty generous. And let's be honest, if you've got less than a 580, there's probably other things going on that's going to keep you from buying a house anyway. One of the downsides to FHA is they charge an upfront mortgage insurance premium of 1.75% of the loan amount. So on $1 million loan, that's $17,500 that's going to be added onto the loan. It can be paid at closing, but nobody ever does that. It can be added onto the loan. So their borrower's not paying it out of pocket, but they're going to eventually pay it when they, sell the house. One of the benefits to FHA is, let's say they do it that way, and then rates drop a little bit. We can do an FHA streamline refinance. It's a no credit qualification, no income documents, no appraisal. FHA, VA really offers the best, but then the second best is an FHA refinance. The downside is you can only have one FHA loan at a time. The other option is they could rent out their current home. So again, the goal here is to keep your offer as clean as possible, not to have any contingencies. Why would you have a contingency? It's either going to be an asset issue or a ratio issue. So the bridge loan could address the asset issue, the FHA loan, the rent out the current home, and then the next one I'll talk about, departing residence and contract, can address the debt to income issue, if that's what is one of the challenges. Fannie Mae allows, if the borrower has past rental income history, like they know how to manage rental properties, then I can take that, let's say they rent the house out, I can take that lease and a copy of the security deposit that has to have cleared their bank account, take 75% of their total monthly lease amount. Let's say it's $10,000 for simple math. I get to use $7,500 of that as rental income. If they do not have any history of managing rental properties, not a problem. I just can't use any additional rental income. I can only offset the principal, interest, tax, and HOA association dues if they have association dues. So basically what we would do is then look at this as they have no current housing liability to hit them for. So that's an option, helping with the debt to income ratio. Another option could be if this property, the departing residence, is in contract, but man, it's just not going to close in time for them to buy the new house. What do we do? Well, give me the contract showing that all contingencies are released. Yeah, maybe they're not closing for a couple of weeks or something like that. But if all contingencies are released, then I can automatically take out the departing residence principal, interest, association dues payment. We call it the PITIA. So we can take that out, which would, obviously help with their debt to income ratio coming back down within guidelines, and then you could proceed with your transaction. So those are the options. There's not 1,000 of them out there because, as Mike has said, and as you probably, just can figure out in your head, it's a hard thing to do if you're going to try to make a new purchase contingent on the sale. There are some solutions out there, but remember what I said at the beginning, there are points of failure with any of these options. Best to do what Elena is doing and get that person with me right away so we can go over the options up front before they even start looking. If they know for a fact they're not going to sell their house before they buy a new one. Now, in the ideal world, you're going to list that departing residence and you're going to get that thing sold, or at least get it to where there's no contingencies left before they start buying a new one. But in the chance you run into someone who just will not have it any other way, these are the options. I'll stop now before I talk about where the interest rate, what interest rates have done over the last 24 hours, and see if there's any questions about that. Or Mike, if you want to say anything.
Are there any questions about this at this time? Let me, when I'm having a conversation with a buyer who wants to buy a property and they want a contingent upon the sale of their property, the question I would ask them is, can you buy a property without selling your existing property? Yes or no? I mean, it's a yes or no question. And if the answer is no, then logically we have to sell your existing property first. The answer is no. So that's something we need to do. Now, usually the issue is I don't want to be homeless. I don't want to stay in a hotel. I don't want to be, keeping all my stuff in a pod and opening it up to get change of clothes and things like that. And so historically, the way we've handled that is by modifying possession. Now, the buyer who's buying their property can give the seller up to 60 days to stay in the property. Lenders will allow it to still be an owner-occupied loan up to 60 days. Now, if the market is really hot, the seller could probably negotiate some of that at no cost to the seller or in a very low cost to the seller. But the worst is you might have to pay rent on the house that you're in for a little while. Right? That's an option. But it would allow us to sell the property, get your money. Now you see, the way I would put it is, if we go from making an offer like in the Santa Rosa, what I told them was, if we go from making an offer in Santa Rosa from a contingent offer on the sale of your property to a non-contingent offer that shows all cash. Which do you think is going to work better? Well, obviously, if it's an all cash offer, that would work a lot better than, if we had a sale of property contingency. How did we prove that we had the cash? We showed them the closing statement from the one that was already in escrow. Because obviously the one in Santa Clara was worth a lot more than the one they were buying in Santa Rosa. Does everybody understand? And by extending the close of escrow or giving the seller a rent back, can buy time for the seller to make these adjustments. And I convinced them that putting their stuff in storage for a week or two while they stayed in a hotel in Petaluma or someplace nice would be cheaper than going through the contingent on each side kind of a transaction. Right? Now, sometimes they won't buy. And they say, no, this is what I want to do. And so then we have to let reality speak for us. Let them make an offer with the sale of property contingency. Let them do it. Right? If the property has recently come on the market and there's going to be multiple offers, they're not going to get it. And they're going to have to lose a few properties before they realize this isn't going to work. One of the things that I've actually said to buyers, I've told them that lawyers have told real estate agents that we should not tell buyers to make non-contingent offers. We should let them make contingent offers. We should let them lose properties and let them self-discover that this system is not going to work. And I said this to buyers and said, now, what do you want me to do? Do you want me to let you self-discover by losing homes you're interested in what'll work or not, or do you want me to just tell you what's going to work? What would you rather? And do you know what they always say? I want you to tell me what's going to work. That's what I want. Because if we see a house, we'd like to buy it. Elena has a question or comment.
Thank you. So this is about the particular case. So in this case, the house they love has been on the market since March. It's 1.9-ish, and they can't really afford it. But let's say they could. Let's say if they had a contingent offer and they could sell their home, they could afford it. In that particular case, would that be a good route to go using the contingency?
If they don't have any other options, we write that offer up and submit it. And if you're saying that Jodie can't get him a loan, or they don't want to get a loan and they don't want to do any of the tactics I've suggested, they want to make it contingent, because usually they want to make them both contingent. Right? They don't want to sell the one they own unless they can buy that one. They don't want to buy that one unless they can sell the, so that they have zero risk. And the answer is, if that's the only way they'll move forward, write it up. Send it to the listing agent, see what happens. Sometimes they accept it, or they'll counter. right? And then you know, we're still talking.
Thank you.
All right. All right, Jody. So are you saying interest rates went down? Are they
You
back in fours now, or?
you would think that that's what I would tell you, but as true form, the Fed funds rate does not have a direct impact on mortgage interest rate. And as a matter of fact, rates went up today. They went up yesterday and they went up Monday. So as I've been preaching this for a long time now, and trying to get borrowers to, believe me, the the Fed dropping a quarter was already priced into the market. That's why we started seeing rates come down. The fact that they dropped it a half, that was kind of already being talked about right before. The issue that we see when looking at mortgage rate pricing is not directly tied to the Fed fund rate. Yes, it has an indirect effect, but what has more of an impact are reports like the jobless claims, consumer price index, inflation numbers. And what happened this morning is that the jobless claims were down about 13,000 or so from estimated numbers. Well, that's a good thing for the employment, people out there looking for jobs, but it has a negative impact on interest rates. So we saw I wouldn't say large, but it was about a quarter increase in cost, not the interest rate. So when we say rates go up or down, yes, does the interest rate move? Well, 6% yesterday, let's say it cost 0. Today, 6% would cost a quarter of a point. So that's what changes. So you pick any rate, and then you can watch that rate, the cost of that rate, change on any given day. So we saw rates come up a little bit. Don't worry about that. We're still going to see rates continue to go down over the next probably year or two, I would imagine. But it's going to be, in my opinion, I think it's going to be a very slow, slow way of getting there. I don't think that it's going to happen quickly. If you think about interest rates, the way I think about them, they can't continue to go down every single day. Otherwise, where's the bottom line? Where do you stop? At 0? Well, we're not going to get there. We're not going to see 3%. I think, pre-pandemic, if I can see the conforming 30-year in the mid-4s, I'm pretty happy. That's where it was before the pandemic, and that to me was a pretty stable real estate market. But getting to 3 or 3.5, if you're going to wait on that to buy or sell or whatever, you're probably not going to see it unless we experience something really, really terrible in the world, like another pandemic, which none of us want. So at the same time, let's not forget that as the Fed fund rate has been so high for the last couple of years, people have made money. If you were keeping your money in cash and you bought a CD or something like that, your 401ks, our stock market is very strong. You've made money. So yes, mortgage interest rate's a little bit higher. Yeah. But so is, 3.4% increase in wages this year. And you've got, people whose assets have grown quite a bit over the last year or two. Does it offset the increase in mortgage rates from 6 to 7? I think it does, but I'm in this I deep dive in it every day, and consumers don't. So it's still a conversation I think we're going to have for quite some time about interest rates. But don't worry, I do not believe that interest rates are going to reverse and start going back up. We're not going to get up to 7 or anything like that. We're hovering about 6.25 or so on a conforming 30-year fixed. If you're FHA or VA, you're going to be in the mid to low 5s right now. Please, call me. If you have closed a transaction in the last couple of years, even if it wasn't with me, with another lender, call that borrower and say, hey, remember how I am of value to you? I'm about to bring you even more value. Give Jodie a call. Let her see if it's time for you to refinance. Of course, they're probably going to talk to their current lender. No problem, but let me at least take a look at it, see if I can get aggressive on pricing to help them go ahead and refinance now. And then, market comes down a little bit later this year, then we can look at refinancing, early into 2025 and probably refinance a couple of times. I will pay the closing costs, and I'm not talking about adding it into the loan, I'm truly going to pay the closing costs where I show them their payoff and their new loan amount, and those two numbers should be similar versus, what a lot of lenders will do is, okay, I'm going to refinance you, no cash out of your pocket. And then you see your new loan amount and it's $4,000 or $5,000 higher than your payoff. Well, that means that you're paying for it. The lender's not. The cash out of your pocket is just kind of it's not a sleazy way of saying it. It's a true way of saying it, but consumers sometimes don't read the fine line there and realize that, you're going to refinance 2 times in 2025, and then you're going to add $10,000 to your loan balance. Well, now you're not really going to get that true benefit of that interest rate reduction. If you close it with me and I'm paying your closing costs, and you're getting a benefit immediately, like that next month, you're benefiting. It's not going to take you 6 or 7 months to see the benefit of paying the closing costs, then let's do it. You guys got my cell number. I'll put it in the chat again. Please don't hesitate to call. I anticipated that the last quarter of this year, I would not be taking trips or going anywhere, and I'm happy about it. It's been a slow couple of years for everybody, and I'm ready to be busy again. So please don't hesitate to call me evenings, weekends, Saturday, Sunday. Let me know. My family is highly encouraging me to work, so you won't get an ignored call from me. Thank you so much for letting me speak, Mike. And of course, if there's any questions, I'm happy to answer.
Let me add one thing to this. One of the things you ought to be doing is talking to the people you already know, people that you've worked with in the past, if you've worked with people in the past. And even if they're not interested in buying or selling real estate right now, you want to position yourself as a real estate resource. So, for example, are you interested in getting a quote on refinancing your current loan? I could help you with that. Are you interested in getting quotes on homeowners insurance? I could help you with that. If you're interested in doing a remodel, let me know. I could help you with that. You need to have, and some of you have seen me do this in my buyer representation, a list of trusted vendors that you could share with somebody. And by helping them, if Jodie helps them refinance and they save money, you're going to get some credit for doing that too, because you're the one that called them and mentioned it. So, and then they like you. And when their friends are talking about buying a house, they might mention your name, which would be a good thing. For people that are waiting, thinking, well, gee, interest rates are probably going to drop, I might as well wait. How much do properties increase in value in California every year? Well, historically, in the last 10 years, it's been going up about 10% a year. They've been doubling about every 10 years. But let's say that property is appreciating in California at 5% a year, and the buyer is interested in an $800,000 property. That's a $40,000 appreciation, or how about that price increase compounded year after year. Now, if you took the $40,000, which is the 5% appreciation, and divided that by the 12 months, the property is going up in value over $3,333 a month. So doesn't that offset the fact that the interest rate's a little bit high? And the other thing to point out is that if the buyer waits for interest rates to drop a lot, assuming that happens, what that means is all the other buyers are going to come out of the woodwork. And are you saving money? Like I remember writing offers, very expensive houses. One of our offers was $500,000 over list price. This was an expensive offer. $500,000 over list price. We had no contingencies. My client didn't even need financing. It was almost a $4 million property. And I was told by the listing agent, he said, sorry, you weren't even close. Weren't even close, right? They had 20 offers and ours wasn't even close. So that was an exaggerated example, but does it really help the client to wait till all the buyers are buying and they're having to offer $20,000, $30,000, $50,000 over list price? They're competing against 10, 20 other buyers. That doesn't necessarily save them money, right? those are conversations you might want to have. Any questions for either of us at this point? I guess we're done. Call Jodie or call me if you have questions that are not finance related.
Thank you.
All right.
Thank you.
Well,
Thank you.
Yeah, thanks.
Guys.
Bye.
Bye. Thank you.